Happy Monday on Tuesday. I'm Tom McClellan. I'm pleased to be your guest this week on the Daily 5. I'm the editor of the McClellan Market Report. And I know that all of you StockCharts.com users are chartists and technical analysts, but I want to have you think for a minute about fundamentals. And I like to say that there are really only two fundamentals that matter. The first is how much money is there. The second is how much does that money want to be invested? If you change either of those, then you'll move the prices. And so everything else will fit into one of those two categories, whether it's dividend yields or book value or anything else that motivates investors to change what their thinking is. All of it fits into these two categories. And so really we should look at these two categories more than anything else because they're what govern the physics of how prices move. To the point on the first one, how much money is there? The Fed is working really, really hard at changing that. There is a chart comparing the S&P 500 to the total of treasuries and mortgage-backed securities, or MBS, that is held by the Fed. Now, they also hold other types of assets, but these two are the ones that they are employing in their quantitative easing and in the way that they try to move the market around and add liquidity or subtract liquidity. You notice that back in 2008, somebody decided it was a good idea for them to reduce their holdings in the middle of the big financial crisis, and it didn't turn out well. Only when they decided to start QE1 in 2009 did we get the market rising, and it rose really, really well right up until the Fed stopped doing QE and we got the flash crash. So they realized, oh, okay, we need to do some more QE. They did it, and that worked really, really well right up until they stopped QE2 in June of 2011, and we got a 19% decline. The market struggled for a while till they started QE3, and it worked really, really well. And then they tapered and let out of it a little bit more slowly, but just cutting off the punch bowl for the market still led to volatility in 2015 and 2016. Quantitative tightening began in 2017. They thought they could reduce their holdings, and they did. And what we got was the short VIX crash and then the big decline in Q4 of 2018. They realized, well, we may need to grease the machine a little bit more, so they started something that Fed Chairman Powell informed us was not QE, but then it turned into real full QE, and it's been growing their balance sheet faster than it's ever grown before, and the market rebound is the natural response to that. They're adding liquidity to the banking system, and it is showing up in predictable places. This is an advanced decline line for corporate high yield bonds, and the data are published every day by FINRA. There's a web link there, so I don't have it in a shorter form for you. You can copy it down. I'll keep talking if you want to write down that long web link, but you can find it there. Corporate high yield bonds behave a whole lot more like stocks than they do like treasury bonds, and so when they're doing well, that's a sign that there's lots of liquidity. So when this advanced decline line is above its moving average, that's a great time to be in the stock market. When it goes below, that's not a good time to be in the stock market. And it gives us nice divergences ahead of big trouble. The regular advanced decline line back in 2018 didn't show us a divergence, but this one did. And it said that there were problems in 2018, and sure enough, there were. Right now, it's saying there are no problems with liquidity. Liquidity is just fine, very healthy, because what the Fed is doing is getting traction and it's going to work. When you see a divergence between prices making a lower high and this advanced decline line making a higher high, you want to listen to this advanced decline line. It says liquidity is just fine. Whatever's bothering the stock market isn't of great importance. Liquidity is what matters, and so you should listen to that. Everybody's worried about the actual economy and everyone getting laid off because of the COVID crash. Here's a comparison of the S&P 500 on a log scale, and I'm showing it compared to the US unemployment rate. And I've inverted the scaling on that one so that you can better see how the two line up quite nicely. Now, here's the worst unemployment rate that we've ever seen in our lifetimes. Hardly anyone was alive during the Great Depression when it was higher than this, but this is pretty bad. So what does that mean for the stock market? If people are not working and earning money, how can they have money to invest in the stock market? That's a really, really good question. The important thing to understand, though, is that the stock market usually bottoms 4 to 6 months ahead of the peak in the unemployment rate. Now, I'm calling this a peak because it's on an inverted scale. Here's the market bottoming in March 2009. Unemployment rate didn't peak until late that year. So the market is usually going to bottom ahead of the worst moment of unemployment. And we've already seen that with the March 2020 bottom, which arrived before the worst part of the unemployment rate. And we should expect that the market's going to do well. Why should a horrible unemployment rate mean that the stock market does well? Well, when you have a bad unemployment rate, what does the Fed do? They keep monetary policy very easy, and that's usually really, really good for the stock market. Looking at long-term bond yields, this is one of my favorite leading indications. Sorry for all the busy lines on the chart, but they do help the eye to see the detail of how the two patterns correlate. What I have on top is crude oil futures prices, and that's been shifted forward in the chart by 3 weeks. And I'm comparing that to the Treasury Yield Index. That's the current yield to maturity on the most recently issued 30-year Treasury bond. The movements in crude oil prices tend to show up again later or get echoed later, 3 weeks later, in the Treasury Yield Index. So when you have a decline in oil prices, 3 weeks later, you get a decline in bond yields. This big decline on first the coronavirus and the Russia-Saudi blow-up has told us about the big decline in bond yields. Now we're at the point, just past the point, where we had the May oil futures contract expiring and it went below zero. This near month price doesn't show that because it had already rolled to the June contract by then. But crude oil prices have rebounded from around 12 up to above 30. So we can expect that over the next 3 weeks, bond yields are going to echo that up move and that crude oil prices already had. They won't necessarily replicate the same magnitude of the move, but it's the dance steps that we care about. If you get the direction right, the magnitude can take care of itself. Last chart of the 5 today, I want to talk about gold. Gold prices have been, they topped earlier this year and have been struggling, just going sideways, but investors have been pouring money into GLD and IAU, which are the two biggest of the gold bullion ETFs. Normally, the assets in these funds go up with rising gold prices and they go down with falling gold prices. What's happening now, though, is different. Gold is going sideways, but people are still pouring money into these funds. They're exchange traded notes is what the ETNs. In other words, this is sentiment that is pure bullish sentiment on gold as opposed to induced sentiment brought about by rising gold prices. People are so excited about owning gold because they think that the Fed printing money is going to drive up the price of gold, which is a reasonable thing to think. It's a reasonable conclusion that if you add more money and keep the amount of gold on the planet the same, that the money to gold ratio is going to change. That's the money to gold ratio is what we call price. That's a totally reasonable belief system. However, everyone is holding that belief system right now. They're all pouring money into gold, even though gold has not really been rising this year. And that tells you that the sentiment on it, gold has gotten a little bit overcooked. When you have everybody believing something, you know it can't possibly work out that way. I'm looking for gold prices to correct lower and fool the majority. For how long, we don't know yet. I can say that the commercial traders and the Commitment of Traders report agree with me that gold is at a good place to sell. The non-reportable traders in the COT report are super excited about gold, as are these ETN buyers. And so when you get the big money, smart money saying it's time to sell, and the hot money saying it's time to chase it, you know which side you want to be on. Thanks for joining me. A little bit about myself. I publish a twice monthly stock market newsletter called the McClellan Market Report. I work with my father, Sherman McClellan, who created the McClellan oscillator back in 1969. It's still my great privilege to get to work with him. We also have a daily edition that comes out every day the market trades. You can sign up for a 2-week free trial of that on our website, mcoscillator.com. We also even have a free weekly chart in focus article. Comes out once a week. It's just a free way to get acquainted with the indicators that we use and what we think is important. We don't do any email marketing. We won't sell your email address. It's just no strings attached way to find out more about the work we do. You can follow me on Twitter at McClellan OSC, or just search for me on Twitter. You can find me. And it's been my pleasure to join you. Thanks very much, and thanks for watching.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.